Hello, future millionaires, and welcome back. Now, as you know, there's been a lot of fear in the stock market, especially with big tech companies such as Microsoft, Meta, and Amazon, which have dropped more than 10% from their all-time highs. This is what actually led me to create this video, as I want to give y'all context as to what's going on and what is the cause of all of this. And on top of that, I want to cover some economic fears so you know what to look for going forward. And before we go forward, I just want to let y'all know that I am not a financial advisor. By no means is this financial advice. I am just a teenager sitting at his desk. So to start off, I kind of want to give y'all some context as to what's going on so you understand why big tech companies have actually fallen a lot. And I mainly attribute this to three main things. The first one being AI related capex. Now, as you know, big tech companies are investing billions of dollars into AI infrastructure. And this number has actually reached over $700 billion. And this has a negative impact onto these businesses' free cash flow, which is actually why the market has punished these companies. Now, if you don't know what free cash flow is, let me explain. So, free cash flow is how much money a business has left over after its operating expenses and capital expenditures or capex. So, if you don't really understand it, let me explain. Imagine that you're a bakery. Your operating expenses would be, the amount of money you need in order to keep your business running. So think of it like this: maybe the wheat and labor expenses, because you obviously need someone to help you out. Maybe you need a cashier or someone that helps you, prepare the bread. And then maybe you could also be paying rent on the location that you have. And, that's the expenses that you need in order to keep your business running. As for capital expenditures, there's two main types of capex. The first one being maintenance capex. And this is just to keep your business running the same way. Say that an oven breaks down, well, you're gonna have to replace it, obviously, and that would be, maintenance capex. As for growth capex, it's the amount of money that you use for, expanding your business. Maybe you want to buy a new location, or maybe you just want to buy more ovens in order to grow your business. Well, that would be what's considered growth capex. And here's the thing: with this free cash flow, you can actually pay your investors through either dividends or share buybacks, which would actually increase their earnings per share or EPS. However, companies are instead deciding to, invest money into AI infrastructure. And from an investor point of view, think about it like this: they're obviously thinking, well, hey, the $700 billion, which you're not giving to us, you're investing it into a technology which we have no clear ROI or return on investment. And you might be asking, well, why do we not know if it has a clear return on investment? Well, because think about it: large language models such as ChatGPT and a lot of them have not yet proved to be that profitable. So when you obviously create that uncertainty as to, oh, we don't know if this investment is going to pay off, and on top of that you're spending billions and billions of dollars into it, investors are like, oh, well, is this worth it? And that's why there's been a large rotation of capital from tech companies onto companies with more stable cash flows. And the thing is that I kind of understand where people are coming from, but think about it like this: these big tech companies are heavily diversified. For example, think Amazon. It doesn't just rely on AI. It has like, a lot of segments of its business. It has retail, cloud, intelligence, and way more. So when you think about it, yeah, sure, investors might have a reason to be kind of fearful, but at the same time, it's not to punish these companies heavily like they are right now. Because sure, there's no doubt that we're not sure if these investments are going to pay off or not. In my opinion, they are, but everyone has their own set of criteria again. But think about it: these companies are heavily diversified. So in my opinion, there's obviously that fear, but then there's obviously that also bullish outlook. Now, the second thing that I actually wanted to talk about was the unemployment rate, and this is actually a strong indicator for a recession. Now, let me actually pull myself down here. If we see, I actually, this is a chart, in the last 3 years, we see how the unemployment rate looks like it's on an upward, trend. And this is actually kind of scary for, anybody. Even if you have a bullish outlook, bearish outlook, well, if you have a bearish outlook, it's obviously even worse. But, for people that are bullish, you have to obviously be aware of this, because the unemployment rate is a strong indicator for a recession. And if for whatever reason we get a recession, which, if you don't know what a recession is two consecutive quarters where the GDP, falls. So yeah, if we have a recession, obviously, spending decreases, the economy does worse, which then it has kind of like a domino effect into big tech companies and every company in general. So yeah, for people that are a little bit bearish, obviously, you kind of might want to go into more defensive stocks. But then again, that's why you need to be on the lookout for this metric, since it is very, very important. Now, last but not least, the last reason why, stocks have kind of been going down and there's been a lot of fear in the market is due to quantitative easing concerns. Now, if you don't know what quantitative easing or quantitative tightening is, I'm going to simplify it a lot, but think about it like this. Now, think that the government, they basically can print a lot of money, which they actually can literally. And think of it like this: there's a room full of money, and when the government prints more money and they add it to this room, basically people, start to invest more in stocks. They start to spend more, and they kind of are like, oh yeah, well, since the economy is doing super well, I'm just gonna keep spending since I don't think that it's gonna do bad soon. However, what the government can also do is do quantitative tightening where they actually start removing money from this room. And when you do that, people become more adverse to, more speculative investments such as stocks, and they start to spend less on, wants and, kind of like going to needs, right? So the thing is that when COVID happened, the government started printing a lot of money, and think of it like this. Think of it like this: the room, they were filling it up with a lot of cash. Why? Well, because the economy was going through a recession, and the Fed and the government didn't just want it to go crashing all the way down, and they needed to provide that kind of cushion for it not to like crash literally. So what they did was starting printing a lot of money. So in a sense, people could, maybe start spending more, and maybe to provide easing to, those businesses that were, going through hard moments. However, this created a lot of inflation, and that basically means that, your dollar became less valuable. Because think about it, say that there's one, piece of gold in the whole entire world, well, it's super valuable. But then when you keep adding 10 more, 10 more, and then 100 more, well, then it starts to become less valuable, that one. So it's the same thing with dollars. When you keep printing a lot of money, well, your money becomes less valuable. So that's basically what happened. And due to that inflation, they started doing a lot of quantitative tightening, or QT, for a while, because obviously, you just can't keep printing money forever. And on top of that, they kept interest rates very high. And this was, just to prevent inflation from getting out of control. And what's recently been happening is that, the Fed chairman has started to do more quantitative easing, and they actually started to, buy bonds. And that's kind of interesting to, hear, because there's a new Fed chairman that was actually elected, which goes heavily against quantitative easing. So it's going to be very interesting to see, what's going to happen, and, kind of like what are his policies going to be. Because obviously, it's going to be interesting to see if he follows whatever Trump tells him to, or if he's going to have a more independent standpoint. So yeah, I think these are the three main concerns that the market has. And as for the quantitative easing, I think it's something that you need to be in the lookout for. However, I don't believe the markets solely base themselves off of this. I think it's just another important factor that, is going to be kind of important, since well, it's a new Fed chairman, and it's kind of important to see how they're going to do that, because they're one of the most, they're some of the most influential people, especially when you're talking about financial markets, because of bonds, stocks, and a lot of stuff. So I hope you enjoyed today's video, because I actually kind of wanted to do it a little bit more quicker, just to kind of give you all a summary of what's going on and what y'all should be in the lookout for. So to kind of summarize, there's been a lot of fear in the market, and this was mainly due to the three reasons. The first one being AI related capex, because there's uncertainty as to how when will these investments pay off. So there's been, a lot of people are moving from tech companies to, more stable companies. Then there's also, the unemployment rate, which is a metric that a lot of people are currently looking at, just to kind of see if a recession happens or not. And last but not least is the quantitative easing, because we want to see when new policies are going to be implemented. So yeah, I hope you enjoyed today's video. If you did, please make sure to like and subscribe, and comment down below if you have any questions. So yeah, I hope you enjoyed it, and have a wonderful day.